All right, let's get right into this explainer. I'm putting on my equity research analyst hat today, and we are going to plunge into a highly data-driven, deeply skeptical teardown of Halliburton's Q2 2026 earnings. Look, we aren't here for the PR gloss. We're here to act as investigative journalists of financial statements. We're going to strip away the hype, ignore the noise, and look directly at the numbers.
But first, disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay, so with the legalese out of the way, take a look at this number. 26.2%. That is Halliburton's return on equity right now. On its face, it's an absolutely incredible figure. But as focused learners, we have to ask ourselves a serious question here. Is this real, sustainable capital efficiency, or is it just an accounting mirage? Does a number like this actually survive a true forensic gauntlet? Well, let's dive into it. Here is our roadmap for today. We just knocked out the analyst disclaimer. Next is the valuation gauntlet, then we'll uncover some media blackout hidden flags, put it through the legendary investor test, and finally define its economic moat and give you a final verdict. First up, the valuation gauntlet, where we apply objective models to current fundamentals. To show you that we're rooting this in serious institutional equity research, take a look at this recent DBS Group report on Halliburton. Notice the buy recommendation and the $41.50 target price. The pros are looking at this stock and seeing some pretty significant upside potential based on their own technical and operational models. This high contrast table shows exactly where Halliburton sits across some key baseline metrics. The forward price-to-earnings ratio is sitting at a very reasonable 10.x, but the absolutely crucial point here is that EV to EBITDA line, it yields just 5.5x. To put that into perspective, that is 1.7 standard deviations below its 5-year mean. Now, we didn't just stop at these baseline metrics. Our back-end analysis ran this stock through an ultimate 21-model institutional gauntlet. We ran Group A cash flow models like unlevered free cash flow. We looked at Group B dividend and income models, Group C comparables. We stress-tested Group D balance sheet asset tests, and even ran Group E advanced options like Black-Scholes real options valuations. And you know what? Across all 21 of those models, the average points directly towards structural deep potential undervaluation. Moving on to Section 2, Media Blackout Hidden Flags. This is where we uncover buried footnotes and unhyped data. You know, there is a massive disconnect between shiny press release narratives about revenue beats and the dense, unvarnished realities found deep inside the SEC 10Q filings. We're going to completely bypass the noise here and extract the raw red and green flags that tell the real story of this company's financial health. Just look at this looming figure, $640 million. This is an IRS notice of proposed adjustment seeking to reclassify a massive past termination fee. If the IRS prevails, Halliburton is on the hook for this entire amount plus interest. And that brings us to our 7 deep red flags extracted strictly from the filings. First, that $640 million IRS notice. The media completely ignores this because tax litigation is just way too dense for a quick soundbite. Second, an 11% Q2 revenue drop in the Middle East and Asia, which gets totally buried under shiny overall global revenue numbers. Third, ongoing geopolitical conflicts shrinking regional activity. This gets ignored because broad macro news typically dominates over localized operational impacts. Fourth, a massive $7.16 billion in total carrying debt, overlooked simply because absolute net income figures grab all the headlines. Fifth, they absorbed $356 million in legacy environmental and severance charges. The media often excludes one-off charges to focus purely on adjusted EPS. Six, weak flat year-on-year revenue growth in Q1, which is ignored in favor of quarter-over-quarter hype. And finally, EBITDA margin stagnation, which is honestly just too technical for most retail investors who only look at top-line growth. But hey, let's flip the script and look at these 7 overlooked green flags. First, they boast a robust 8.1% 5-year average free cash flow margin, a metric totally overlooked by outlets obsessed only with top-line growth. Second, their free cash flow volatility ratio versus crude prices is incredibly stable at just 5.6, which is ignored because commodity price shock narratives drive much better TV ratings. Third, Q2 cash flow from operations hit a staggering $824 million. And let's face it, cash flow from ops rarely gets the splashy coverage of EPS beats. Fourth, Q2 free cash flow generation was $668 million. Again, media prefers adjusted earnings over actual cash generation. Fifth, they executed $308 million in year-to-date share buybacks, well below intrinsic value, ignored because buybacks lack the flashiness of new product announcements. Sixth, that high capital efficiency of 26.2% ROE, mostly because capital structure nuances don't fit into a 30-second TV segment. And seventh, a deeply entrenched historical dividend commitment, because boring, reliable consistency doesn't exactly generate clicks. And this brilliantly illustrates that very last point. Halliburton's shareholder return timeline spans decades. We have records of consistent dividends dating way back to 1972. They maintained these payouts through the 1980s oil gluts, the 1999 price crashes, and they survived the Great Recession of 2008 without suspending returns. Fast forward to today in 2026, and they're still putting out consistent 17-cent quarterly payouts. That kind of historical capital discipline is exceptionally rare.
All right, Section 3, the legendary investor test. Let's do a Buffett, Lynch, and Graham reality check. What would the actual investing greats think of this setup? Let's start with Warren Buffett's owner's earnings test. Does it have consistently high returns on equity over 15%? Yes, ROE is sitting beautifully at 26.2%. Does it have predictable earnings? Yes, evidenced by that highly insulated cash profitability we just talked about. But what about debt management? Well, the net debt to equity ratio sits at 71.1%. Now, while that's totally manageable with their cash flow, a strict Buffett disciple might require a second look at that leverage. But do they have an economic moat? Absolutely, they are a dominant North American market leader.
Moving over to Peter Lynch, applying his PEG ratio, price to earnings divided by growth, we factor in the forward PE of 10.0 and steady cash growth, finding it sits comfortably below 1.0, making it highly attractive under his specific criteria. His fair value test, adding the 2.2% dividend yield, also passes with flying colors. Now, as for the godfather of value himself, Ben Graham, calculating his specific Graham number, the square root of 22.5 times EPS times book value per share, yields an intrinsic value comfortably above current trading levels. It easily passes his primary valuation test requiring a PE under 15, clocking in right at 10.0. However, I will say a strict Graham follower might balk at the price-to-book multiple of 2.6x. Still, overall, it scores exceptionally well across the board. Finally, Section 4, Economic Moat and Final Verdict, where we synthesize the 10Q teardown. Take a look at how they actually make their money here. Nearly half of all Halliburton's revenue is derived from its massive, market-leading hydraulic fracturing and completion segment. They are essentially the backbone of North American well construction. Look, this isn't just some generic services company. They are a dominant, highly specialized force. Which leads us to officially defining their economic moat using Morningstar's 5 sources. They possess massive, efficient scale as the undisputed leader in North American fracturing. They have incredible intangibles in the form of advanced proprietary technology like iCruise, Zeus, and Logix. They also benefit heavily from high switching costs because their software and services are deeply structurally integrated into the workflows of major operators. And the trend? This moat isn't shrinking. It's actively expanding over the next 3 years, driven by strategic digital AI partnerships, specifically their recent collaboration with Shape Digital. So, here is our final verdict based strictly on the data. Undervalued. By averaging the calculated intrinsic values across our full 21-model institutional valuation gauntlet, including an EV to EBITDA at 5.5x and a forward PE of 10.0x, the consensus pulls Halliburton firmly into deeply undervalued territory based purely on its fundamental cash generation capabilities. But I want to leave you with a nuanced takeaway here. The core engine of Halliburton is incredibly strong. It commands an expanding moat, and it is generating fantastic insulated free cash flow. But as an investor, you literally cannot afford to put on blinders. You must continuously monitor the forensic risks. Specifically, those ongoing geopolitical headwinds, shrinking revenue in the Middle East, and that massive $640 million IRS legal dispute just hanging out in the footnotes. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework.